I'm completing a financial review for a multi-seven-figure business, and I wanted to take you through how I analyze numbers so hopefully you can extract some valuable insights. And hopefully this shows you the power of having a great financial dashboard as you grow and scale your multi-seven-figure business to 8 figures. Now, this is completely anonymous, however, these are real numbers, so let me run you through this. So we're looking at a year-to-date period. When we review financial reports for a particular client, we always run it like a marathon. The financial year is a marathon, and we want to review it as a year-to-date running against that marathon. We break the year down into 4 equal sprints, and we were working towards those quarterly targets. However, if we fall off track for one particular month, or even a particular quarter, we make a course correction and make adjustments to ensure that we can get that business back on track by the end of the financial year. This isn't binary or pass or fail. So when we look at the numbers, we've got revenue for the year to date of $414,000. We've got cost of sales of $145,000. We've got expenses of $224,000, which leaves us with an operating profit of just shy of $45,000. Now, as revenue compared to the last year, we are 82% to date. So considering that we are 3 months into the financial year, we're a little bit behind the 8 ball. However, this business does have some seasonal revenue, so we definitely have a little bit of catch up to do. For the last year, we've done 2.347 million. The year prior was 2.11 million, and the year prior to that is 1.818 million, which shows that we've got a consistent track history of growing and scaling the top line revenue of the business. We then have cost of sales. This particular business has a lot of subcontractors, so we are down 87% because we've been focusing heavily on trying to optimize the cost of sales in this particular business. So prior year we had 1.1 million, prior year was about 1.169 million, and then the prior year was 932,000. So when we're looking at a business like this, we really want to pay attention to the gross profit, or what we also refer to as the real revenue of the business. So we've currently got 269,000. The previous year was 1.187. Previous year was 940, and the previous year was 885. And the reason why this is important is this is basically the real revenue that we've got to run the business. So we're down 77%. As we can see, we've made up a little bit of our ground because we've been more efficient in our cost of sales. Now, when we look at the expenses, we've done 224,000 of expenses, which is basically down 80% to the previous time last year. We had spent 1.1 million, 950, and 879 respectively. And obviously what that leads us with is the operating profit. For this financial year so far, we've made $44,000, nearly $45,000 in operating profit. For the entire previous financial year, they only made $62,000. The year prior was negative $10,000, and the year prior was only $6,000 in profit. So we are on track to potentially 4x the profit at a minimum. If we can continue to grow top line revenue, continue to control cost of sales, and continue to control expenses, then this business is definitely on track to do significantly more profit than what they've done historically. So when we have a look at the relationship in terms of the revenue for all time, we can see the history of that revenue, and obviously in the new financial year, we have started basically from scratch, but we're building our way up, and our idea is to try and get this business to $3 million in revenue while maintaining a net profit margin of around about 20%. So our aim should be that business should do $600,000 in profit this financial year. And as we can see, the business as it was growing went from a negative to about a break-even position, and has had an EBITDA in the prior year of under 100,000, and we're basically almost on track for exceeding that EBITDA calculation for this financial year, and we're only 3 months in, which is very, very exciting. And as we can see, the net income growth is even looking better. Now, when we look at the balance sheet is really important for a business like this, particularly as they're continuing to grow and scale, because most businesses completely ignore their balance sheet. They don't pay attention to the amount of cash that they've got available or their cash flow, because your P&L only tells one chapter of the story. So our accounts receivable is $546,000, and this is something that we're definitely working on aggressively with this particular client. They invoice an account, and their payment terms have not been followed up. There hasn't been a really good accounts receivable policy. So we need to make sure we collect on this cash, because basically the clients of this business are treating them like an interest-free bank, and that is not acceptable. Our accounts payable is reasonable for a business like this, but because of the amount of accounts receivable, this certainly creates a cash flow issue. And our cash on hand has increased exponentially. We've got the business bank account up to $178,000 because we've been already collecting a lot of this accounts receivable, and that's up 68% on the prior year. As we've seen for the previous years, the cash account has been relatively low. They've basically been running on the smell of an oil rag. So that's something that we've certainly been working on fixing. And when we collect this cash, they're going to have more cash than they know what to do with. So that leaves us with a total current assets of 178,915, which is something that we just need to be mindful of when it comes to looking at the liabilities to understand what we call our current ratio. Okay, so total assets in the business is 228,000. It's a service business, so we're not too focused on the asset utilization. But what we want to keep an eye on is the current liabilities. So our current liabilities are, of course, our accounts payable and any of our accrued tax liabilities or short-term liabilities. So this business currently has about 88,000. We want to ensure that our current assets is always 2 times that. So we're basically at that point right now. We've got good liquidity. If we've got additional cash collected as a result of that accounts receivable, we're going to be in a far better position. Okay. So now we get into the cash flow, and this cash flow gives us a really good understanding of how the cash flows in and out of the P&L and the balance sheet in order to influence the bank account. So year to date, we've had 414,000 in cash received. We've spent 145,000 in cost of sales. We've had expenses of 224,000. We've had changes in accounts payable of 29,000. And we've had changes in other current liabilities of $1,700. So our operating cash flow in the business is $73,000. We've had a slight change in fixed assets, which left us with a free cash flow of just shy of 73,000. We've had a little bit of change in other items, which that's basically our ending position. So we can see we started with 106,000. We've added 72,766, which leaves us with a closing balance of 178,915. Okay, so that's a really good position for us to be in to continue to grow that cash, which is obviously what we're focusing on doing for this particular business. Okay, so our goal is current liabilities, not too focused about our. We want to focus on our current assets. How do we collect that cash, and how do we continue to improve the cash flow trend of the business? And how we do that is we track the KPIs. We've got various KPIs across the business that we're focusing on of low, medium, high, and critical importance, and we're reviewing them on an incremental basis over time to ensure that we can get the various metrics that are concerning under control. So accounts receivable days, 82 days right now. Too big, particularly given that they're paying their bills in 19 days. That means that they're having to cover the cost of those outgoings before they get paid. And really, it's about how do we optimize this profitability ratio. Our goal is to get that profitability ratio consistently up to 20%. We're very confident that we can do this in this particular business. We've done it with many of our other clients, which is going to drastically improve their profitability and their cash flow, and in turn, their ability to build wealth. Now, the big thing we want to focus on is these kind of primary growth metrics, because we've got to understand that growth isn't free. So we want to make sure that we are optimizing our revenue growth, but also our gross profit and our EBIT growth. So for this particular business, revenue growth is a little bit down because we've been focusing on optimization. Our big focus is at gross profit growth, which is up 30%, which is fantastic. Our EBIT growth is something we need to get under control, which is basically something that we're focusing on at the moment based on the cash collection of this particular business.